Hey there, folks. I remember when I was just a sprout dipping my toes into the world of investing. I was green as grass, eager to make my fortune. I bought my first few stocks on a whim based on a hot tip from a friend. Oh boy, that did not pan out well. I was chasing the next big thing, falling for the allure of quick profits. I lost a chunk of my hard-earned cash, but that first bitter taste of failure was a vital lesson. It taught me that investing isn't about chasing trends or getting rich quick. It's about discipline, patience, and a good deal of research. Those early mistakes, they were stepping stones, each one a hard-earned lesson that shaped my understanding of the market, honed my instincts, and guided my investment strategy. If I had known then what I know now, my investment journey would have looked very different. One of the first things I learned was the power of patience. Let's take a moment to consider the investment approach of one of the wealthiest individuals in the world, Warren Buffett. Now, Buffett's strategy isn't about chasing quick profits or jumping on the latest trends. No, his approach is rooted in the principle of patience. He is known for his buy and hold investment strategy, a method that requires an immense amount of patience. Imagine this. You've just invested in a company, but instead of selling the moment the stock price increases, you hold on to it. You're not swayed by the market's daily fluctuations or temporary downturns. You're playing the long game. This, my friends, is the essence of Buffett's strategy, and it's how he's built his billion-dollar empire. Buffett himself has often said our favorite holding period is forever. And it's this mindset, this unwavering patience, that has allowed him to reap significant returns over time. Patience is key because it allows you to ride out the market's volatility and capitalize on the long-term growth that companies can provide. It's important to remember that the stock market isn't a get-rich-quick scheme. It's a platform where businesses grow and develop over time. And as an investor, it's your job to identify these businesses, invest in them, and then wait. Just wait. Because the real magic happens over time. This approach requires a disciplined mindset. You're going to face temptation. You'll see stocks skyrocketing and you'll want to jump in. But remember, investing is not about timing the market. It's about time in the market. And the more time you give your investments, the greater your potential returns can be. So, if you're looking for a tactic that the top 1% of investors use to get rich, here it is. Patience. It's simple yet powerful, and it's a strategy that has stood the test of time. As Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. So let's be patient, let's be disciplined, and let's watch as our investments grow. Another key tactic learned was the art of diversification. Let's delve into the world of Ray Dalio, one of the most successful investors of our time. The founder of Bridgewater Associates, Dalio is known for his strategy of risk parity, a concept that revolutionized the investment landscape. But what is risk parity? It's a strategy that seeks to balance the risk contributions of various asset classes within a portfolio, rather than just focusing on their expected returns. In simpler terms, it's not about putting all your eggs in one basket, but rather spreading them across multiple baskets. This approach helps to spread the risk and potentially increase returns. It's not about chasing the next big thing, but about creating a stable and resilient portfolio that can weather financial storms. The beauty of risk parity is that it doesn't rely on predicting which asset class will outperform the others. Instead, it focuses on achieving a balance where each asset contributes equally to the overall risk of the portfolio. This way, even if one asset underperforms, the others can pick up the slack, reducing the potential for catastrophic losses. Dalio's strategy is a testament to the power of diversification. He didn't become a billionaire by making risky bets on single stocks or sectors. Instead, he spread his investments across a wide range of asset classes, from stocks and bonds to commodities and currencies. But here's the catch. Diversification isn't a one-size-fits-all approach. It requires careful planning and continuous adjustment. You need to consider your financial goals, risk tolerance, and investment horizon. And you need to keep an eye on market trends and economic indicators, adjusting your portfolio as needed to maintain balance. Diversification isn't just about buying different stocks or bonds. It's about understanding how these investments interact with each other and how they can work together to reduce risk and enhance returns. It's about creating a portfolio that's greater than the sum of its parts. Diversification is not just about having different investments, but about creating a balanced portfolio. Research, my friends, is the backbone of successful investing. If you've ever heard of Peter Lynch, one of the most successful mutual fund managers of all time, you'll know that he's famous for his invest in what you know strategy. But what does that really mean? Well, it doesn't mean you should blindly invest in your favorite coffee shop or the tech giant whose smartphone you can't live without. No, it's more nuanced than that. It means understanding the business behind the stock. It means knowing what they do, how they make money, and what their future prospects look like. It means being able to explain in simple terms why you believe in this company's potential for growth. Take a look at Lynch's track record. During his tenure at Fidelity Magellan from 1977 to 1990, the fund's annual average return was an astonishing 29.2%. How did he achieve this incredible feat? Through diligent, thorough research. He studied companies, understood their business models, and identified their potential for growth before making a decision. Lynch would often visit the companies he was interested in, talk to their employees and even their customers. He would immerse himself in the industry, read trade journals, and attend industry conferences. He was not just looking for a quick tip or insider information. He was seeking a deep understanding of the business and the industry it operated in. Now you might be thinking, I don't have the time to do all that research, and that's a valid point, but here's the thing, you don't have to do it alone. There are plenty of resources out there that can help you. Financial news outlets, investment blogs, company reports, and even social media can provide valuable insights. The key is to be discerning, critical, and thoughtful in your research. You see, when it comes to investing, knowledge truly is power. The more you understand about a company, the more informed your investment decisions will be, and the more informed your decisions, the higher your potential returns. So start your research today, dive deep, ask questions, seek understanding. Remember, an investment in knowledge pays the best interest. In my 20 years of investing, I've learned a lot from the best in the business. The lessons I've gleaned from the top 1% of investors have been instrumental in shaping my investment philosophy and approach. So let's recap what we've learned so far, shall we? First off, patience. It's not just a virtue, it's a necessity in the world of investing. The top investors didn't amass their wealth overnight. It was a gradual process, built on the back of long-term investments and the power of compound interest. So, remember, Rome wasn't built in a day, and neither will your investment portfolio. Next up, diversification. The adage, don't put all your eggs in one basket, rings particularly true in investing. The best investors spread their investments across different asset classes, sectors, and geographical regions. This strategy not only minimizes risk but also maximizes potential returns. Diversification has been key to my growth as an investor, allowing me to weather market downturns and capitalize on opportunities. And then there's the importance of research. The top investors are voracious readers and learners. They understand the value of information and make their investment decisions based on thorough analysis and understanding of the market dynamics. In my initial years, I made the mistake of following the herd, only to realize that the key to success lies in independent thinking and informed decision-making. Now, you might be wondering, how does this all tie into personal growth as an investor? Well, each of these tactics has taught me valuable lessons. Patience has taught me the value of persistence and long-term thinking. Diversification has taught me the importance of being open to new ideas and opportunities. And research has taught me the power of knowledge and continuous learning. The path to investment success is rarely a straight line, but with these tactics you can navigate the twists and turns like a pro. Remember, each day is an opportunity to learn, to grow, and to inch a step closer to your investment goals. So, stay patient, keep diversifying, and never stop learning. So, what's the secret sauce to becoming a top investor? Well, there's no magic formula, but there are a few key principles. Patience, for one, is paramount. It's not about quick wins, but long-term gains. It's about playing the long game, waiting for the right opportunities and not being swayed by market volatility. Then there's diversification. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes to mitigate risk and maximize potential returns. And of course, there's research. Knowledge is power in the investing world. Stay informed, keep up with market trends, analyze financial reports, and understand the businesses you're investing in. These principles aren't just for the top 1% of investors, they're for everyone. They're the foundation of successful investing. Remember, every top investor started somewhere. With the right tactics, who knows, you could be the next Warren Buffett or Ray Dalio.